What's up, everyone? Dylan here. I wanted to hop on for another episode of the weekly analysis video. It's important to note that this is the last full market week because next week we have Christmas and then the following week you have the New Year. So those are shortened holiday weeks. Okay, and ending off this year on the last full week comes with a very, very busy calendar. Starting tomorrow and then every single day after to end of the week, we have a very, very important event each day. So tomorrow you have retail sales. Then on Wednesday you have FOMC with Fed Powell's press conference following that. And then Thursday you have jobless claims and GDP. And then Friday you have PCE. So it's very, very important to be prepared for each one of these days and have a good understanding of where the key areas lie on your chart so that you can be one step ahead of the crowd. Okay? Very, very important. So let's get into price action. Last week's video, I mentioned two areas of a critical resistance on the S&P and the NASDAQ and how they were kind of failing at those areas with momentum also coming off and some RSI metrics to look at as well. Okay, and right around the 11.5-minute mark of last week's video, I said, quote unquote, where am I looking at for this pullback to kind of stop at? And I mentioned 21,370 on the NASDAQ. So I'm going to go ahead and draw that and show you how that played out. Okay, so what I mentioned was that level stemmed from these two tops in the NASDAQ, which was established back in July 11th of 2024. And then again, it double topped there again on November 11th, 2024. Okay. So since the breakout occurred, that line had not been retested as of last Monday when I posted the last video. Okay. But if we go ahead and pan over to what occurred, that is exactly where the bulls stepped in. Okay. So I posted this video right around here and I said, hey, like I said, where am I looking at for this pullback to kind of stop at? And that's exactly it. Now, did I want it to bounce there? Not necessarily. I mean, my long-term portfolio kind of like that because since then it has rallied about, a little over 3.5%. But as I mentioned last week, I was in a long VIX position. And since then, because the S&P stabilized and moved higher, led by the NASDAQ, the VIX failed to sustain value and ended up pulling back. And basically, since the beginning of December, it has been in a total chop, sideways move. Okay, so I ended up stopping out of the remaining contracts for a very, very small win. Okay, so the fact that the NASDAQ bounced there wasn't too much of a surprise. As I mentioned last week's video, I said technically the relatively stronger name should bounce there. And as you can see, the NASDAQ over the last week, over the last month, has outperformed the S&P and the other indices, right? If we look at the last week, NASDAQ is up 2.13% relative to the S&P being down a quarter of a percentage point. Okay, and that takes me to the next important part. So despite the NASDAQ being so damn resilient, the other indices have not participated in such a rally, right? In fact, you could see it very, very clearly here with the S&P making lower highs. Like I said, massive difference with the NASDAQ basically making a new all-time high every single day, every single session, whereas the S&P can't get out of its own way, and every single time this thing tries to rally, these sellers are basically capping each rally with a lid. Okay, and going forward, I'm going to take you through the Dow Jones and the Russell as well, which look even worse. And this statement is from Adam Crisafulli, who is a market analyst or market commentator, whatever you want to call him. But he said near-term market internals are not appealing with deteriorating breadth and signs of concentrated froth. So let's get into that. I agree with that statement, right? despite the NASDAQ being resilient at all-time highs, the S&P can't get out of its own way, and the Dow Jones has fallen, what is this, 8 consecutive days? 1, 2, 3, 4, 5, 6, 7, 8. 8 consecutive red days, which A, doesn't happen often at all, but B, almost never happens when you have the S&P and the NASDAQ sustaining value. Okay, that is very rare. I don't know a specific statistic, in terms of these breadths. I'm gonna get into a historical statistic, but it's not specifically about the Dow Jones. Okay, on top of that, the Russell has also been declining. Okay, and on top of that, let's go even further. RSP, which is the equal weighted ETF, as if the 11 sectors in the S&P were not dynamically weighted, right, based on market capitalization. RSP has declined 11 days in a row, I believe. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 days in a row. That is crazy. And then you look at NYA, which is the NYSE Composite Index, which shows a large basketful filled with different stocks in amongst basically every sector out there, has also been declining. Okay, technically this is not ideal. Okay, because what it implies is the names that are outperforming, mainly the Magnificent Seven, we're going to get into that, those names, right? Basically what this implies is if those names stop outperforming, will the market be able to sustain value if you take away that source of resilience, right? And the answer is unknown, but you have to wonder that, right? And that's just me speaking in very, very broad, plain English terms. Okay, so let's look at the Mag7. MAGS is the ticker, right? Round Hill Magnificent 7 ETF. Okay, and if we go to the ticker profile, you could see that MAGS, at the time of launch, is the first ever basically Magnificent 7 ETF in the U.S. market space. The fund targets a narrow portfolio of 5 to 10 stocks, publicly known as the tech giants. So what are those? Those are the names that have been outperforming: Apple, Amazon, Google, right? All of these names that I'm listing are specifically the reason as to why the NASDAQ remains so damn strong and resilient. Okay, so you have a crazy move like that, where it's no surprise that the MAGS ticker, the Mag7, is performing on a very, very, very impressive note. In fact, if we go a step further, right, the MAGS is up 14% in the last month. 14%. Whereas QQQ is up 7% in the last month. The Mag7 is basically doubling the delta percentage, increase on in terms of valuation relative to the tech sector as a whole, right? Meaning that there is so much concentrated froth, right? Just like Adam Crisafulli said, okay? And it's concerning because when you talk about froth, right, we're basically meaning that they're essentially overextended, right? And we could look at this on the RSI, right? The RSI gives us a quantitative metric showing that these Magnificent 7 names are basically all in overbought territory. So is it sustainable? I don't know. Could this technically last for another month, 2 months, 3 months? Yes, but it's not likely. Okay, so you have Mags at crazy RSI overbought levels. You have Tesla crazy overbought. You have Apple crazy overbought, right? All of these RSIs are at levels that usually are not sustainable. Okay, so like I said, if those names hypothetically were to stop outperforming and to start coming off and pulling back, you have to wonder, would that make the overall stock market also pull back? And I would think yes, but Adam Crisafulli he disagrees. He says, either the tech melt-up soon loses steam and the rally broadens, right? Meaning the top 7 names start to kind of come off and the rest of the broader market start to outperform, right? Or the entirety equity landscape will be vulnerable. Okay, and he says, I think the former is more likely than the latter. Okay, like I said, could Adam be correct? Could Dylan be wrong? Absolutely. But what I'm thinking is if you take away those 7 names, the outperformance on those 7 names, and they start to all kind of pull back, I believe that sets up for market, very, very vulnerable conditions and ultimately, a pullback for the entire market. Now, is that going to happen? I have no idea, okay? However, it's very important to look at those names and if you want to make your that objective easier, you could just look at MAGS instead of looking at 7 different individual names separately. You could look at MAGS. But I think that is very, very important. On top of the mags, you also have semiconductors outperforming as well, right? And I've talked about how semiconductors are high beta, meaning they have a very, very strong influence on the overall market. And I'll bring up the Discord. I said this on the 13th, which was Friday. I said, keep a close eye on this macro SOX wedge. SOX will gap up upon market open due to Broadcom's overnight move, blah, blah, blah. Ultimately, right, whichever way the wedge breakout occurs will likely take S&P and the NASDAQ with it. And this is the chart that I posted. You could see that it was still in the middle. And then, like I said, when Broadcom, when 9:30 hit and the market opened, this thing gapped up to close to the top of that wedge, okay? And since then, if we bring up SOX, you could see it did in fact break out. And what has the NASDAQ done? It has gone with it. Okay, so I think SOX is a very, very important chart to keep an eye on as well. If you are a bull, you want it to stay above that trend line. Okay, if it comes back, you want that trend line to then act as support. If it cannot, and if price gets back within the wedge, that will likely take the NASDAQ down with it. Okay, so that's very, very important. Now, for the remainder of this video, I'm going to go into the specific month contracts on the March, because as of probably tomorrow, TradingView is going to roll the continuous contracts from December to March contracts. So I figured I'd make it so that you guys have specific levels on those instead of looking at the D still. Okay, so where are we, right? Where is Dylan looking at going forward? To start off, I want to give a downside level on the S&P, okay? This area to the downside is very important, okay? And I'm going to draw it out. Like I said, we're now on the March contract, so understand that there's a price discrepancy between Dec and March, okay? So this general area here on the S&P has acted as previous resistance, right? You could see multiple market failures at that. Then upon breakout, it kind of pulled back and retested this area. And since then, it has acted as support not once, not twice, but 3 times. So going forward, that 6,117 to say 6,107 10-point area is going to be very, very important to gauge, price action around. Basically, the bulls want it to sustain above that and get bought on dips at or above there. And then on the flip side, the bears would want to see price lose support at that general 10-point support area and stay below there. Okay. On top of that, the VIX remains very, very, very important. Like I said, since the beginning of December, it has been totally sideways. I mean, like I said, this is the beginning of December right here. If I'm going to go ahead and draw like a vertical line, this is the beginning of December from that black line on. Since the black line on, it has been completely sideways. And because of that, because the fact that it has been sideways, it has been taking pressure off of the S&P, and as a result, every time the S&P has pulled back and dipped, the bulls have a more, an easier, more effective ability to buy that dip and defend that dip and essentially make price stay higher. Okay? If and when this sideways move breaks to the upside and sustains value higher, I think that would put more pressure on the S&P and as a result maybe increase the overall selling pressure. Okay, so let's go ahead and draw that line. Okay, so I'm going to go ahead and draw it from December 3rd, and then I'm going to attach it to the highs of December 9th, and then again the highs of Friday. Okay, and then if you want to draw it like this too, you certainly can to mark it to the high of the 13th, right? So whatever way you want to do it, the bottom way or the top way, it means the same thing. So basically, we're right at that general area. Like I said, I would imagine that if the VIX futures can break above and sustain, very, very important, because clearly it has tried to break up 4 or 5 different times since the beginning of December, but it has been unable to sustain and stay up there at like say 14.7, 14.75, 14.8. It has been unable to stay up there for more than a couple hours. So the ability to break above, stay up there, and then gain traction to the upside would likely put more pressure on the S&P. And the higher the VIX goes, the more pressure that gets puts on the S&P, and that sets up for the highest probability that selling pressure or market pullbacks will have the highest probability of persisting. Okay, so if the S&P drops, but the VIX futures do not break out, that would likely lead to dips being defended, that pattern of dips being defended continuing. Okay. However, if the VIX breaks out and really gains traction to the upside, I think that if the market sells off, if the S&P sells off, that would kind of change the sentiment from buying the dip to selling the rip. Okay, that's very, very important. And then I also wanted to show this, right, going back to the breadth, because I mentioned that I had a specific statistic. So it says this came out today by Bloomberg. While the S&P continues to drift higher to new record highs, right, over the last couple weeks, the picture under the hood is anything but positive, right? The breadth has declined for 11 straight days, right? Looking at the RSP. This is the longest streak of net daily declines in breadth since the aftermath of 9/11. This is over 20 years of data. This has not happened since 9/11 of 2001, okay, since after 9/11. So clearly that is very, 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 important. On top of that, this is from Bespoke Invest, just another visual of that unappealing breadth, right? Deteriorating breadth. And you could see the last week or so, the last couple weeks, every single sector in the S&P, right? 11 different sectors, 4 here, 4 there, and 3 there, right? Have been declining, right? Real estate, healthcare has been declining, consumer staples declining, right? We're just going off this most recent move. Financials have been declining, material, right? So, and Bespoke Invest says you'd never guess that the S&P was just 60 basis points, right? Meaning 0.6% below all-time highs by the looks of these 10-day advanced decline line charts, right? So I wanted to really, really stress that and show you how, rare this really is, okay? And then in terms of to the upside, the level to the upside to look at is the all-time highs on the March contract, which sits at 6,178.75 on the S&P. So if you do see a nice rally over the next few days with the busy calendar ahead of us, it will be important to assess how price action reacts to that previous all-time high, which was made on Friday, December 6th. And the bull's main objective is to break above there and hold. Okay, so that's it for me. I wanted to mention one other thing. I appreciate everyone's support on these videos. It goes a long way. It makes me excited to post more and more about, statistics and what I'm watching, stuff like that. And every 1,000 subs that I get, I do a live webinar where it's basically an open-ended Q&A and we chart some stuff. So coming up on 4,000 subs, I will be doing one of those live streams soon. So hopefully by next week I get to that 4,000 mark, and I will announce when I'm going to hop on to do that live webinar. And that's it. That's about it for me. I will talk to everyone soon. Peace.